Birds.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on a special episode of the show because, I don't know, when you have Basel III come and go, the price gets hammered. Yet, of course, as in anything in life, there's always the details, the things that, banks are not going to go out of their way to tell you and explain. So what better solution than to have the top expert in the silver world who's been doing this long enough? You got to be at least in the top three. I mean, there's David Morgan, a few other guys, but perhaps my last part of my introduction of Craig, I still remember back sitting on my New York Stock Exchange post 2010, 2011, when all these guys thought I was a complete Fruit Loop talking about gold and silver. And one of my favorite ways to keep my sanity was wait for a new podcast or an interview with Craig. And how fortunate am I to have him join me on the show a couple days after this Basel thing. And also have the silver delivery period. I said Basel, you start sneezing. Normal reaction, Craig, though. I'll stop with that. We'll cover banks first and then get on to the good stuff. Bless you, sir. How are you doing today?
It was a live show. Can you tell? I'm doing everything I can. I'm like holding my nose, where you press your finger up against your nose. All right.
Collector's items, though, Craig. It always gets censored out of the other stuff. So this is a special treat in my book.
I'm going to sneeze again, I think. Hold on.
Bless you, my friend. That's okay. I can tell banker jokes if you reaction. I'll stop with that. We'll cover banks first. Got my line there. But Craig, anyway, it's great to have you on here. And perhaps to get started, and we're going to dig into whether these silver banks have actually reached the point, or maybe are incredibly close to the point where they're running out of silver. Again, it's like a poker game. We don't see the cards, but as we'll go through, when I look at the things that have happened in the past couple months since February 1st, it seems like we have to be getting close to that point. And we will dig into that. Although first, I know people, I'm seeing the comments on Twitter about Basel III, and it seems like people have thrown in the towel, which on one hand, I can understand. Although if even the diehards are giving up and going for the hills, that's usually the sign that we've hit a bottom if no one's left to sell. So can you start with Basel III? What happened? Does it mean anything? What do you think there?
All right, look, here's the thing. And I find this extremely frustrating. Okay. It's nice. I appreciate you considering me an expert. I suppose that's only by attrition, right? You do this long enough and you become like the old man maven in the space. But look, this
one could say if you get things right consistently year after year and explain, even in the challenging times when the Keynesian analysts don't want to show up, it's just another view, but continue.
But Chris, this is what pisses me off, because there's so much, people just want shit for free. They just want to go to Twitter and then they latch onto something and then expect that that's going to be the be all end all. And then they get pissed off. Oh, this didn't work out. So this is all just a scam and everybody's a pumper. So look, first of all, I'm going to pump my site because it's only $15 a month. And if you remember my site, then you would have not been bummed out on Monday. Okay. You can't just think it. What did somebody tell me once? A lot of times things that are free have no value. Okay. So if you're going to Twitter and hearing, oh God, June 28th, man, it all going to end. Well, you know what you got? You got information of no value. I was trying all the way up to Friday. You can check my Twitter feed at TF Metals to tell people, look, this is just the first step on Monday. Okay. Now look, it's significant. And I had Alistair come on my show. I have Tom Luongo come on my show. I talked to Rob Kirby, all these people about Basel III and this net stable funding ratio that was being put into place. It is important, but June 28th was not like the world, you were going to wake up that morning and the world was going to change. And so if that's what you thought was going to happen, frankly, shame on you. You didn't do the homework. Okay. There's two important things here. One, how it's happening in stages, and two, why? You got to ask yourself, why is this happening? Let's start with the implementation stages. What June 28th was a deadline for the EU-based banks to be in compliance with this net stable funding ratio or net stable funding requirement, however you want to say it. Okay.
And Craig, just for anyone who's hearing that for the first time, can you give a quick definition of what that means as much as is possible?
Basically, it meant you had to, having your unallocated gold, you couldn't have it just on the books anymore. You had to have actually allocated gold. And there was a ratio cap. I don't even know if I can explain it, obviously. But what it did is it made holding just simply unallocated gold impossible in terms of, or had to have allocated gold, actual physical gold, rather than all this phony baloney, trading unallocated accounts in London and everywhere else, and all the supported alleged hedging that these banks have been doing for years. So to bring yourself in compliance with that, you had to bring a capital ratio up to a certain level if you're going to keep doing that. Otherwise, you just get out of it. Now, this impacted the EU-based banks first. Okay, this wasn't like a system-wide world-changing event on June 28th. This was just the EU. So who are EU-based banks? Credit Suisse, okay, Deutsche Bank, UBS, all right? So these are bullion bank players, but they're not like, this is not everybody. Now, then I went and I found somebody, actually, I didn't find it, somebody emailed it to me. A notice from the US Comptroller of the Currency, which is the office that tabulates all the derivative trading and, and everything else. You get those reports once a quarter. They put out a thing in February that said, it sure read to me, and I sent it off to Alistair and asked him, I said, is this basically the same directive going out for US-based banks to get in compliance with all this stuff from Basel III? And we looked at it, yeah, sure looks like it. That's tomorrow, okay? Well, the world's not going to end tomorrow either. Now, I definitely think what you've seen the last 2 weeks has a lot to do with these requirements being put in place. I mean, why was gold run down $100 on a short squeeze in the dollar? Interest rates have moved. Real interest rates still sharply negative, but gold runs down $100. Why? Because the futures tail wags the spot dog. If you can collapse the futures price, then the spot price goes down $100. And if you are underwater and you need immediate allocation to cover your unallocated stuff, or you need to get out of it completely, you'd sure rather do it $100 lower, here at the end of the month than it was at the beginning of the month. But anyway, it's a process. It's not just June 28th. And frankly, nothing can even hold a candle to the, fingers crossed, implementation of all this in London, the UK banks, and the LBMA on the first of the year, January of 22, 6 months from now. And what's going to continue to drive me crazy is we're very likely to continue to see these raids and this price pressure, because if LBMA is not let off the hook by January 1st, well, then all of those banks and all the obligation of the LBMA, that's going to become not necessarily a wasteland, but that's a lot of unallocated paper that's got to get covered and moved around, all that stuff between now and the first of the year. You think June was ugly? God knows what they'll try to do between now and the first of the year. So anyway, I back on that. I didn't mean to go off on this rant, but I've seen that crap too. And it's like just bad information, or people that are so desperate, they're so tired of this crap that they'll cling to anything. Say, okay, June 28th, that's our day. And then June 28th comes and goes and they're just pissed off, and it was never going to be it's a big deal, okay, that these EU banks were called to the carpet finally. But it was never going to be. Again, check my Twitter feed. I've been telling people this most recently on Friday. It's like, before you head out for the weekend, understand that nothing is changing on Monday. So anyway, I'm sorry. That's a long.
No apology necessary. I think at the heart of it, it's that shared frustration where I've been saying people have been waiting for 41 years, although maybe we'll dig into this a little later, because I've been reading a couple of books about the Hunt brothers. This was going to happen long before that as well. I think silver would have gone past 50 in 1980 if they hadn't changed. The series of rules changes they did were basically described by multiple authors who were there. I'm not reading this off the internet. They basically were changing the rules until the price came down. Right. So I get people feel that, being a silver investor is good practice in simulating getting hit over the head with a shovel time after time. So I understand when we hear Basel III, June 28th, people are excited. Although you mentioned Alistair McLeod, even he, was probably one of the most vocal ones saying that this will happen, said he didn't expect the price to go right away. And actually, Craig, when you think about it, given that the silver deliveries began last night, and then we also know, I believe today is the 30th, which is the close of the quarter. Certainly there are banking experts who can explain to me how that works with capital requirement, but it would almost make sense, especially with the silver deliveries, Basel III or not, you were going to see this thing pummel down, especially yesterday. That was actually pretty predictable. Yeah.
That's how it always works. That's how it always works. And the biggest disappointment, I even just wrote yesterday, I thought maybe we had a chance to have a really hefty, not like the COMEX is going to fail in July. You always get that crap too, and it's a lot of times it's the same people that come out, about this date certain, the COMEX is going to collapse. And I'm like, I've heard that before, and that doesn't do anybody any good. That's why this whole Basel III thing was just driving. But anyway, what we do want though, is this continued demand, this robust demand, where there's really only so much silver flowing every year out of the mines and out of recycling that either gets chewed up by industrial demand or by investment demand. And when you get investment demand to eat up all the rest, the industrial demand is pretty steady at 550 or 600 million ounces a year, which leaves 250, 300 million ounces for everything else. And when you all of a sudden spike to 400 million ounces of investment demand, well, you're short, and then you got everybody's favorite Hell's Angel tries to tell you that there's, 5 billion ounces laying around if you count grandmother's candlesticks and silverware and tea setting. But, at $26, grandmother's tea setting's not for sale. Okay. So it's not like, it's just this big pile over here. Anytime London needs it, they can get it. So anyway, we got to keep the demand going. I thought maybe July'd be, because we still had 19, almost 20,000 contracts still open with 1 day to go. That's 100 million ounces. And usually it's a rather linear progression. Every day you get closer to that contract going off the board and into its delivery phase. You get people leaving that contract where all the action was, all the open interest, all the trading is usually what's in that called that front month. Right. So you get people rolling out of the front month of July into then the next one, which is September, or even farther out, December. And yesterday there was 19, almost 20,000 left. They rolled that about 12,000 of those just sold. It's not like, there's anything, funky going on. They just sold, and about 5,000 rolled into September. The other 7 just gave up and said, I'm just out. I'm not going to stand for delivery. I'm just selling my contract, which is what you do. I thought more like maybe 8,000 would do that, and we'd still have 12,000 hanging around, but instead, we have 8,000. So it'll still be a hefty month, still a lot of pressure, still more than, we ever used to see back in the day. But it's just another step on the road. We just got to keep the pressure up. We know, again, from all the great work you've done, Chris, and some of the people at Wall Street Silver and the like, about how little silver there really is in London, this living off this flow. All these notes have come out from the US Mint about trying to source silver, all that stuff. So we just got to keep the pressure on. And that, again, I think we're doing okay. It's nice in terms of price. We came down. We've been hugging the 200-day moving average now for 8 or 9 trading days. Got below again yesterday, but then bounced right back today. We're now putting the end of the quarter behind us. That's always a good thing. And we can talk about those short-term things if you want. But I bought more silver yesterday. You probably bought some recently as well. So we're hanging in there.
Yeah, well, actually, I'll tell you offline a little plan I've been cooking up that I think you'll find amusing. Plus, we do have our Drain the COMEX Silver Special coming up. Red hot 4th of July party. We're just going to sell the 1,000-ounce bars directly at a ridiculously low price and see, just have a little fun doing that. Look, Craig, one thing you mentioned in there, I know you said before that to caution against people who say the COMEX is going to blow up, whatever blow up actually means. While I would agree, certainly to expect it to happen tomorrow might not be the best idea. Is this a matter of when rather than if that we're somehow headed towards the collapse of the London gold pool part 2?
Yeah.
Is it an inevitability, even if we let go of the actual date?
Yes, it is. I've been writing about that for a decade now. But what's so important is that people understand that if you start, placing all your hopes on any one certain day, you're just going to be disappointed. And then you're going to walk away and you're going to give up your financial insurance that is, physical gold and silver. You're going to walk away from a repricing back to some, basis in the physical world that is going to be a financial windfall for you as well. So I try to keep everybody, kind of more focused on this bigger picture. I mean, the rubber band keeps getting pulled tighter and tighter, more. I mean, eventually you just don't know when it's going to finally snap. You look at it, begins to fray and you think, oh boy, I certainly can't do this. And then you can do that. Well, okay. And that's kind of what's going on there. We know, like, for example, Ronan Manley has done all this great work, counting, keeping track of all the information the LBMA puts out about London. And they try to say that, these hundreds of metric tons of unallocated gold that trades every single freaking day, they try to say, well, that's no problem. Look at that. We've got 9,000 metric tons of gold here. And what then everybody says, okay. What nobody ever says, well, 5,700 tons are from the Bank of England. They're probably going to want that back. That's probably not up for sale. And then they, allegedly, well, we got all this ETF gold that's stored there. And then when it gets down to brass tacks, the most they could possibly have, if it was actually up for sale, is like 800 tons. Okay, but they're trading multiples of that on a daily basis. Yeah. And so it's really, and that's where that gets back to this Basel thing, because it's all unallocated. It's just like, they shifted either from one side. Andrew McGuire always said they have he's been down there and they've actually got blue lines like masking tape, like painter's masking tape on the concrete floor of the ball.
The tag from one pile to the other.
Yeah. Or they bring in the forklift and pick it up and move it one slot over and set it back down. And then the rest of it is just all this unallocated, just pretend stuff. Well, no, I got it. The bank says I do. And so they keep stretching that as much as they can. At what point does that break? This is why we've always talked about, you just need to pull at one of these threads, whether it's, all this Perth Mint stuff that is so aggressively covered up by all media, not just the little Kitco guy, but no, I mean, isn't that crazy, Chris? You sit there, Rob and Dan, who are like auditors and forensic accountants. I mean, it's not like Chris and Craig, who are just a couple knuckleheads. These guys are serious people that know what they're talking about. And so
books and stuff.
The little Kitco guy rolls out Dick Hayes to say, oh, no, that ain't no problem. Or that other dude, Kevin, whatever, Rich. Oh, everything's fine. Just look at the website. Everything's fine. And then that's the end of the story. Because everybody has an interest in perpetuating the thing. Nobody with their beaks in the trough wants to see this. They want to keep it going as long as they possibly can. And so at some point, though, we pull it enough of these threads that the thing begins to unravel and people go, wait a second, this is not. And that's actually then, that does get then to this whole Basel III thing, because we didn't really talk about that before. Why? Because that's the main thing that I think is most interesting. They wrote all this stuff in 2013? Yeah. In response to financial crisis, something like that. And then it's been kind of kicked and kicked and kicked and kicked. And now here we are in 21 and then into 22 that it's finally being forced to be implemented. That's the bigger question. I mean, why? I mean, the LBMA has been pleading, please don't make us do this. It's going to dry up liquidity. Yeah, it is. So why?
I actually have a theory on that, which fortunately ties into the title of today's show. We'll mix some rumor mill and speculation in here. So by all means, don't write down any dates here, but just a couple things to think about. let's say that after 2011, silver spikes to 50, and 2008, the whole thing melts down. I mean, I know we hear these like Jerome Powell Bernanke and Janet Yellen, say silly things on TV that make no sense, and people get fooled by like raising interest rates. I heard they pulled that whopper out again yesterday. Saw that in my inbox. But let's say that there's someone in this whole saga that has some common sense, can see the obvious, realize this is a matter of borrowed time, could explain some of the things that happened. I mean, why did Germany ask for their gold? Why did Poland ask for their gold? I mean, these things happen. No one answers. And I guess what I wonder, and Craig, bear with me, this would be like a slightly long question, but then I'll let you take it away.
Anyway, I'm kidding.
If we're in agreement that there's a set number of silver and there's an imbalance, and at someday we're going to hit London Gold Pool Part 2. So we'll make it a Bayes theorem conditional probability, which us option trading geeks like. So are we running out of silver? Now, I sat there and wondered, all right, I see all this, slam the paper, blah, blah, blah. But for the last 10 years, it's gone on. You see, and we won't take these numbers as gospel, but let's say they're close. Total supply, about 1 billion ounces a year, right? From Silver Institute. Then we look at total demand. So if you take this number, now we have net physical demand in here, but otherwise it's industrial, photography, jewelry, silverware.
Mm-hmm.
So let's call this here, last year is 900 minus 200. That means industrial, if you include all those, photo, jewelry, has been about 700. Here, 966 minus this year in 2017, it was 800.
Steady and predictable.
So basically, you can simplify it where if there's 1 billion, it's the supply, 800 is the 7 to 800, 600, call it whatever the range you want. But you subtract the difference, 2 to 400 million ounces a year is what's left over for investment. Now, if you create that same effect that we discussed before, where people are like, hey, I see Tesla soaring, all the stocks are firing. I don't want to sit here with silver and be patient for what may happen one day. So if you kill the demand interest, you can keep that number lower. But then we get over here to 2020, where we have net physical demand was 200 and into the ETPs or ETFs 330. So there you have a problem, which could explain why the price jumped $10 suddenly last July. Now, I don't know. I mean, we had 120 million ounces go into the trust in a weekend, and they only expect 150 for the year and only 250 for physical, but that's still 400, which puts them in the problem zone.
Mm-hmm.
We had the LBMA write a report say they were scared because they were fears emerged because they were weeks away from running out of metal, and it's good to go as long as Wall Street silver goes away. And now, last I checked, they're up to 120,000 users, and that didn't exist when Silver Squeeze weekend hit. I talked with you, David Morgan, auditor Rob Keynes, when they posted 61 million shares on February 2nd, the day that the price fell 10%. And what now I can say comfortably was the greatest single day of demand in history. We all agree that it's impossible for that to happen. We find out months later, the LBMA says there's a miscount, which, all right, miscount, maybe it was an error, maybe it wasn't. That's still, no one has explained how the price fell and where that metal came from. Ed Moy is a former US Mint director. So, hey, I'm not part of the Mint. I can guess, but this guy was running the damn thing.
Yeah.
The interviewer who asked him if they have all the silver was so shocked. She asked twice. She said, wait, I just want to make sure I understand this correctly. Are you saying that you don't think there's enough silver? He says no. I mean, we have these weird emails from the US Mint where one day it's a silver shortage. A couple of days later, they're missing the blanks, which doesn't seem like, you dropped a decimal point there. Then we have this Basel III thing, which, hey, whether whatever it is now, that's interesting timing. And then perhaps the last one that I'll leave you with, and then you can tell me what to make of all this. 2 weeks ago on June 17th, when the price of silver falls $1.50, Dave Kranzler calls me, says, hey, can you check with Andy? I just talked to Monex. They're buying the heck out of it. Andy Scheckman of Miles Franklin says the same thing. I said, is there something else, or why is that happening? He says, people know it's rigged. They get it now.
Yeah.
So if when silver goes over $30, they bring JM Bullion on CNBC and the Wall Street Journal's writing articles, and it's a buying panic. But if the price goes down, we see some form, I think what I just described, frantic buying, panic buying, whatever word you want to use. Or, I mean, it's like if you're playing a poker game, you don't see the guy's cards, but you look at their actions. Does it indicate that either they're pretty darn close or they have to be getting close? And maybe Basel III, whether they're going to tell us which day it's rolled out or not. You wrote about how we've seen the bank participation report, the short position reducing over the last year. So in terms of we know, what do we do going forward? Do you think, how do you connect all of those data points?
Well, we're definitely making progress. I mean, I don't think that's deniable. And the more people that understand, wait a second, I see, and this really started last March 20, when price went to 12, the COMEX price, but yet you couldn't buy it for anywhere for 24, 25. It's like, well, what's really the price, right? It's not really 12, I guess, it's 25. And the more people understand that, just more power, it's in the power of the crowd, to exploit that and bring attention to it. You mentioned though, and getting back to the why of the Basel III part, I'm going to throw in a couple of anecdotal things. One, it was about, I didn't have to think about it, a year ago, maybe. I don't know if you remember this, but there was a member of parliament in the UK that actually read into the record price manipulation and what the banks were doing.
I believe that was Jeremy Lefroy, right?
Yeah, that's his name. So anyway, and he, as it turns out, he was a friend. He's the guy that but like a guy Andrew Maguire is known for years, and he consulted with Andy as to what to say and all that kind of stuff. Well, this got the attention of the lead regulator in the UK, the UK's SEC, basically. Okay, that guy's name was Andrew Bailey. Now, which may ring a bell for a few people, but anyway, Andrew Maguire, this MP, got to meet with Andrew Bailey and some of his big shots. And Andy, as he told me, he laid this out to Bailey, this incredible risk that the banks, and then by extension, the LBMA were taking through this pyramid scheme, whatever you want to call it, of unallocated accounts. And this Bailey was like, wait a second. It's like he had no idea. And they laid it all out to him. Just this open-ended risk that they were taking by running this scheme. And this guy was like, I thought we're not doing this again. If these banks can't come to us for another check, we did that in 2008 and 9. We can't do this again. And so that was like a year ago. Well, now Bailey is now the head of the Bank of England. Okay, so put that in the back of your mind. So then as we talk about the Bank of International Settlements, which is the bank for the central banks, is all of a sudden pressing this Basel III thing and actually making it happen, and is unrelenting on the demand. The LBMA, like I said, whining, complaining, like little girls, wanting to not have this imposed on them by January the 1st, and the BIS is not. And so there's a component there, an actual regulatory component where these central banks are like, look, maybe this is too much risk, not only in gold, but in silver too. And then we'll go one step further. I talked to a guy by the name of Tom Luongo, who actually is kind of cool. He was a member of my site like 10 years ago, and then is growing, gets cited on Zero Hedge, his articles and stuff like that. His site is like Gold, Guns and Ammo, or Sheep and Ammo. I can't remember. Tom, let me spell his name, Luongo. Look that up instead. Anyway, very sharp guy. And he said, and I add a lot to this, he said the reason the Bank of International Settlements is doing this is because they know they may need a higher gold price, especially for the ECB. Okay. Right now, and I'm going to just back up for just a second. Right now, you're seeing gold fall, even though we have negative 3.5% real interest rates in the US off the 10-year, and gold is falling. And it's all part of this transitory crap, where the word transitory and all that stuff is just simply the Fed jawboning yield curve control, right? What's yield curve control? We're not going to let the 10-year go past 1.5% or whatever, right? They know they can't let rates rise. That's why they're keeping them low through 2023. You know, QE keeps going, even though it's like, why? Because they cannot allow rates to rise. Why? Just do the math on financing the $30 trillion in debt, but then extrapolate that across all public and private debt and mortgage rates and security and credit cards and all that kind of stuff. So the only way you can get somebody, an institution, insurance company, whatever, to buy a 10-year treasury at 1.5% when inflation is 5% is if you can convince them it's not really 5%, it's going back to 1.5%. Otherwise, you're locking in a 3% loss of purchasing power. What idiot does that? So as part of this transitory stuff, isn't it handy that gold's been falling, right? Because if gold was soaring like it should be on real interest rates being sharply negative and was at 2,500 or 3,000, which if you'd have told me we'd be at negative 3.5% real interest rates by now, if you'd have told me that back in January, I'd have thought, oh my God, we'll be at new all-time highs easy. And if gold was soaring, would that fit the transitory negative, the narrative? Of course not. Okay, so all of that's how these puzzle pieces fit together. But now finally, getting back to Tom Luongo, the ECB has the largest in dollar, or if you want to, go ahead and value it in euros, largest balance sheet on the planet. Okay, they're at like $9 trillion, 8 trillion euros at this point, and growing by leaps and bounds every single week, right? Real rates in Germany have been negative now for 5 freaking years, and they just keep going. What? Even 5-year Greek papers down to 0. So they just keep buying it because that's the only thing that's the only policy they have to fight deflation is to keep printing euros. And the only way they can print euros is to keep buying all this EU-based debt. Okay, now, but here's the problem. This is what Tom Luongo's point was. That's really all they have is this balance sheet. The Fed has other options. The ECB does not. And if rates rise, and they got to mark all that stuff to market, because as rates rise, bond prices fall. If rates rise, which maybe inevitably they do in some type of crisis, all of a sudden that $8 trillion is valued at, or euros, is valued at 6, 5. And the ECB becomes insolvent. What asset do they have, Chris, to counter against that? About 10,000 tons of gold. So maybe at some point here, and that's also part of why the Bank of International Settlements is pressing Basel now upon all these banks, because they know for their own survival, maybe they actually turn the tables and they need a higher gold price at some point. So there's a lot of pieces here, and this gets us back to where we started. Please, I beg you, do not get all turned off and say, screw this, I'm going to go buy some Tesla, just simply because June 28th has come and gone. That's just one step in the process, man. And so let's just play out over the next 6 months, and then we'll see what happens.
Well, certainly well said, Craig, because, hey, if you can see where this is headed, you can turn the TV off, turn the computer off, just leave your gold and silver. I don't know. I feel comfortable. That's for everybody to do themselves, but at least for me, I have fun. I'm going to hit the pool later. And I know at some point this is going to blow up. And right. Again, everybody has to figure that out for themselves. Look, Craig, before we take a question or two in the last couple minutes we have left, would you like a little Andrew Bailey related stunning mind blower?
Dude, lay it on me.
I found when I'm trying to go to sleep, and then I start flipping around on Twitter and checking silly things. I did find this from the CFTC's website, which was kind of intriguing. Now, Andrew Bailey, I don't know if he appears in this one. I saw him somewhere else, but look at the all-star cast here. Board of Governors of the Federal Reserve, CFTC, FDIC, Office of Comptroller of the Currency, SEC. So let's get Gary Gensler involved. We also have the media contacts listed for Bank of England as well. Mm-hmm. This is June 25th, 3 days before Basel III, joint readout of principals meeting of UK and US authority regarding central counterparty resolution. So obviously this is worded in lawyer speak. I won't insult anyone's earbuds by trying to read this. Although I find it fascinating, you keep hearing about the CCP involvement. And Craig, I'll say that I appreciate, or you're free to say whatever you like. We've kind of stayed in what you can factually support. Maybe some other day we'll do like a private, what I actually think is happening, my best guess when I incorporate the rumors and stuff that I couldn't confirm. But I mean, what do you think went on at this meeting? And I guess this speaks to it here, June 29th, yesterday, CFTC staff issues interpretation of swap dealers regarding capital requirements. I think, like you said,
does that mention Basel III in there any place? Because capital requirements, that's kind of what Basel III is about. Is
calculating net capital. I mean, they all have their different names. In the end, we're guessing, but it's like,
yeah,
let's say like I can't see what's on the other side of that building, but there's people running and screaming and crying. They're in flames, and then everyone's panicking. There's probably something going on. I mean, we see these things, you know, of course, they don't actually tell you with transparency, but is there enough to say that you don't, hey, maybe China's finally had enough, or Putin? I mean, the guy sits there, buys gold, tells you he's tired of the, he actually called it the Rothschild dollar. See, Nibbles is excited about that one, understandably. Nibbles, do you know when they're going to raise the gold price? I don't know, but can we see there's enough there to just relax about it and move forward in some level without getting, in fact, I was thinking about that the other day, where think about how much negative energy it generates when people get worked up about this stuff. And from everything I hear, that's actually part of the plan, get people sucked in, versus the more you just buy your silver, go do something fun. Is that the best thing people could possibly do?
Right. I couldn't agree more. And I definitely, that's a great find. And again, it has to be all related, because otherwise, why would that be on June the 25th, right before this week, when the EU-based banks have to, get out of the unallocated gold game, and then the American banks as well. You mentioned, I've been tracking the bank participation report, which is a once-a-month thing that comes out from the CFTC. Every month, the new one will come out, should be on Friday. And the US bank position in gold, which again, it's just an aggregate of the 4 or 5 banks that have the largest positions. We're talking JP Morgan and Morgan Stanley, Citigroup, Goldman Sachs. That has been shrinking dramatically over the last 90 days to levels that I've only seen at at the bottom in 2015. So I'll be very curious to see what they, they try to say, well, we're hedging this, we're doing this with the mining company, but there's no way. They measure the hedge book. The last time I saw, the total amount of hedged producer mining was the equivalent of 80,000 COMEX contracts. Okay, well, first of all, they don't do it all just on COMEX. Second of all, what's the other 370,000 contracts of open interest, right? What's the other, all these other bank positions? So are the banks in their own trading accounts, we know that's what they do, are they being forced to kind of eliminate that stuff? Not necessarily shut down the trading desk yet, but are they paring back positions, covering unallocated positions, which again, as I said, are a lot more comfortable to do at $26 silver and 17 below $1,800 gold than it was at $28 and $1,900 gold. So I think we're trending that direction. Again, you can connect all these dots, but here I am, just right back to where we started. Please, everybody listening to us, man. June 28th was never going to be. It's just the first step. All right. Watch the headlines. If we get into November and suddenly there's a press release, the Bank of International Settlements, due to blah, 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 has decided to give the LBMA an extra 12-month extension, that kind of thing. And you can roll your eyes and go, okay. But they haven't yet. And that's what we're going to be targeting. That's the real thing. When the LBMA is forced to greatly curtail what they do with the unallocated metal, then we'll be making some progress. And again, that sure looks to be coming first of January.
Yeah, well said. And I'd add to that, when I see those comments again of the frustration, I get it, but
yeah,
gee, based on what we've just discussed for the last 40 minutes, if there's ever been a point in time where people actually have some impact, I mean, they've told you buying the silver is becoming a real problem. So, I mean, by all means, I would definitely dare people not to buy a 1,000-ounce silver bar when we run that smoking hot 4th of July special. I mean, all you guys on Wall Street Silver, the LBMA told you were kicking their ass. Please stop. We don't have a backup plan. So we'll leave that there. What's that?
Don't give up now, for God's sake. I mean, just because silver is the same price it was at the 1st of January, come on, don't. We're making serious progress. And just for what you're doing, anybody that's never actually held a 1,000-ounce bar, I mean, it's pretty cool. It's like the size of a small shoebox. It's about like that. And it's, 60 pounds. Hey, and if anything, it's a great doorstop, and you can work out with it. Get it, take it home. You can sit there and curl it. You can press it over your head, do all kinds of cool stuff with it. And it's better than dollars. If you had $26,000, what good is that? Besides, if you're a JP Morgan trader and you're looking to throw it, go to the strip joint. Other than that, I mean, what good are at least that bar is sound money, and you could exercise with it.
Craig, I'm definitely marking you down for a pre-order spot when I start selling silver gym equipment, silver golf clubs. My team, we're making a list, silver dice. We're going to make the cubes already. Although, Craig, real quick, I know you have a couple minutes left. I wanted to get one question in there. And before we do that, mention that today's episode was brought to you by the kind folks, First Majestic Silver. And certainly another leader in this whole saga, Keith Neumeyer, who's spoken up, understands what is, times has withheld production, and now has the silver sitting there. And I know there's people who say, well, they were tired of hearing about it. It's going to happen when it happens. And so anyway, thank you to First Majestic. And along those lines, Craig, because the first question that I will take here, we may only have time for one or two more. I know you have to run in a minute. But Fritz Bender says, Craig, how do you see the miners panning out until September? So any thoughts there? And if you do have any comment on First Majestic as well.
Well, we're entering into earnings season again. As soon as we get into July, we'll start getting production reports, stuff like that from all the producers. And then once we get to about the last week of July, then you'll start getting all the actual earnings reports. So you're going to want to look and see, well, what was price during the second quarter last year, so that you can look and see how earnings are going to be perceived, year over year and, versus the same time last year. And in gold last year, we spent a lot of time during this. I'm just kind of rolling my eyes trying to remember, between 1680 and 1780. So the average price was probably like 1720. Here in the second quarter this year, we did a lot higher than that, mainly in the 18s. And so I'd say, so earnings are going to look pretty favorable. And you look at the chart of some of those things like the GDX, if you want to use that as a proxy for the gold miners, man, has it had the crap kicked out of it. The day that the 50-day moving average moved up through the 200-day, which is an incredibly bullish sign, it went up from 38 to 39. And then every day after that, it went straight in the toilet, which is like, oh, that's interesting. But it's definitely washed out. The GDX got its lowest RSI, relative strength index, that it's been, at least for the last 12 months, way down into extremely oversold territory. So the miners are due to a bounce here. But how, the miners are just like the metals. Nobody wants to buy them when they're down. I mean, everybody wants to rush in once they feel like they're seeing a breakout and the train is, pulling out of the station and all that kind of stuff. And so between now and September and October, that kind of thing, I don't know. I just think prices are headed higher, especially you get later into this year and into next, because this transitory thing is going to be shown for what it is. So I've not held it or not sold a single share. I just keep holding all my core positions, and I just keep adding to it. I think the miners are just fine. Man, that was
because if you get companies that know what they're doing, they have a good balance sheet, the business is run well. All right, if we get to September, October, the price is whatever it is. What are you going to sell it and buy treasuries again?
Like First Majestic, great. I mean, there are a number of companies like that, and you just have a diversified portfolio, and you'll be fine. Like I said, I'm obviously bullish on the long-term prospects of all this, so I wouldn't want anybody to get shaken out over what might happen in the next month.
Makes a lot of sense. Again, not legal financial advice, but just the kind of common sense you can't find on Wall Street.
We're just a couple dopes just talking over coffee.
Yeah, and Craig, I know you got to run, so we'll make this the last one. It's a two-parter because Thomas asked Craig exactly where he buries his precious metals. And I was wondering if you could tell me the link to your website. Maybe you bury it in there, but any thoughts there as we wrap up, my friend?
Yes, it is buried in a safe at the bottom of an unknown, undisclosed river. Oh, look at that. Hold on. Go back. Look at that.
Under there? Is that a silver button on the site?
Yeah, look at that nice spike, though, in prices. This is important. All right. I was going to make this point earlier. So since that was just kind of a funny question, I want to make this point. Do you see that if you shorten that up, the spike this morning where we went up to whatever, well, that's silver. Click on gold real quick because silver is, whatever. But gold spiked this morning right after 10 o'clock Eastern. Now, why would that be? Because 10 o'clock Eastern is the time of the London PM fix, 3 o'clock London time. Oh, and what's today? Today's the last day of the month and the last day of the quarter. So imagine that. The banks managed to pin price to 1760 for the last 2 weeks. These are important things you have to understand, man. I mean, remember Michael Nowak, who was indicted? He was not only the head of JP Morgan Precious Metals Trading, he was also on the board of the LBMA.
And also friends with the CFTC ex-regulators.
Right, exactly. Who's his attorney now? But anyway, all right. So you're in London. You're a bullion bank in London where all the metal flows, and you got to allocate it. Orders get filled at certain prices, and you got to flow it here, and you got to allocate it there, and all this kind of jazz. You want price at a certain point. You need price below a certain point. Maybe some orders don't fill. So you call up your trading desk in New York and you say, hey, spoof that shit. Whatever you got to do, get that price down because I can't have that order filled today. We don't have the metal. We got to get it out of the GLD, whatever. Okay, that's how this stuff works hand in glove. So the fact that, again, here we are today, either price dumps into the fix for whatever, imagine that. Price fell $10 before the fix or $25 yesterday. Right at the COMEX Open for no reason. That's this bullion bank collusion trying to make all the pieces fit together on a daily basis. Now, sometimes it's a dollar moving or the bond market or some headline, but a lot of times when there's light volume like yesterday, man, that's exactly where it's coming from. Well, that's what you got to understand. You can't just count your Elliott waves. You can't just sit there and wish for a price you got to understand how this stuff works, how it all fits together. So I do a little TA, understanding that the banks are going to do TA and try to use it against you, like, the 200-day moving average where gold was pinned right until they pulled the plug out from under it. After the FOMC, it was pinned at the 200-day for 5 days. Then you get maximum effect by dropping it through there. So we do a little TA, but as you look down, there's a post every morning, a podcast every afternoon. I'm just everybody's eyes and ears. Because again, if anybody's going to be put in the grave early by all this stuff, I want it to be me. I don't want everybody else. I'll be the one wearing the stress, having to watch this crap every day. So for me to tell you what has happened overnight and tell you in a podcast what has happened during the day, it costs you a whopping 50 cents per day. How's that? $15 a month. But look, it was very kind of you to say I'm this old man, maven, expert and stuff. But I do think that there's some value to what we
And
do.
where I started my learning process while I was going up on the stock exchange.
You're very kind. You're very kind. So, but again, look, it'd be rather arrogant of me to say, well, we got to charge $100 a month for that because I'm brilliant and all that. Yeah, well, whatever. It's $15 a month. Keeps a light on, pays my ever increasing healthcare insurance costs, pays for the servers, all that kind of jazz. So anyway, $15 a month, tfmetalsreport.com. And look, even if you just sign up for a month and decide this is not what I want to do, especially in times like this, I think it's worth every penny.
Yeah, well, I think so. Plus, I was noticing, I hadn't seen this before, but here you can get an economic calendar with funny names for all of the Fed officials, Goon Williams, Goon Barkin. You like that one, Nibbles, don't you? And then plus you have Silver Babes retweeting your content. I mean, that sounds like pretty celebrity status to me. And in fact, Craig, I will tell you what, for all those people who are logged in the chat listening live today, Yara, who is the moderator, perhaps could pick a winner. I would like to personally fund, buy someone a winner, a subscription to this. So Craig, we'll figure out how to do that. And also, I know last time you were on, we gave away to people who signed up new a copy of the audio Big Silver short. So which chapter 3, this guy from TF Metals really laid it out clearly, even talked about palladium before it unraveled. So if you want to check someone's track record, if you just think people are saying something that might happen one day, they could read or hear that. I'm happy to throw that in if that's helpful, if people enjoyed it, and you let me know. But we'll also, hopefully Yara can pick someone with a silvery attitude today out there that can have a new subscription and participate.
Chris, you're extraordinarily generous. And I do remember doing that last time. And we did give away some books. The best, but here's what I should then do, because the best way for me to keep track of people that actually join based off of this discussion, I'll put on a coupon code.
Silver Vacation. It's got to be Silver Vacation. That's my deal breaker.
Silver Vacation?
See.
One word?
Yeah, I mean, Silverfest 2 is coming right around the corner. Now, this is Bill I just moved into yesterday, but I think clearly imagine if people could have a coffee or margarita or whatever they like to drink while they're in a pool. And Craig, I know you're considering it. Are we going to see you there?
I swore I'd never go back to Mexico 20 years ago.
What if the pool is lined with silver?
How about how about chicks in silver bikinis? But anyway,
all right, ladies, you heard it. Anyway, if we get enough silver bikini women, I'm trying to be appropriate here, but sounds like Craig is in. We won't tell you about that last part, but that's okay.
Let's do this before we go. If you go to tfmetalsreport.com, you hit the subscribe button, you set up an account where you pick a username and all that stuff. You get to the end, you select a monthly subscription, the one that's $15 a month. You go to checkout, you'll get a chance, there'll be a coupon code box. And just type in the word, the silver I don't even know if I can make it that long. Let's just call it silver. Just type in the word silver. That will give you half off your first month. So that'll save you $7.50. If you stick around, it'll be double to 15. But hey, that'll save you $7.50, man. What's a margarita go for at this resort?
Well, I'm still, this is just my villa. I'm finding the perfect.
Where you're going to have this thing, if people come, it'll be, let's just say it's a $7.50 margarita. Hey, I got your first one. All right. Sign up for TF Metals Report. It'll save you, put in that coupon code SILVER. That'll save you. Now don't do it right now. I haven't done it yet. Okay. Give me a second once we sign off to go to my site and put that in. And then that'll give you half off. I'll let Chris know. He'll send you the audiobook and everybody will win by hopefully learning a little more, not being faked out by things like Monday. But I do have to go because I got another thing at the top of the hour with Dr. Janda.
All right, Craig. Well, I sure appreciate that. I might add that your fan, the Silver Babe, has awarded Jenny Alicia. Oh, she's been moved off of your feed.
That's just the latest. Yeah, that's just my Twitter
to TF Metals. So go get them. Thank you so much for joining me here today, and appreciate everything that you do and stand for and all your support. And it's it's going to be fun watching all of the action unfold. That much I am sure of.
Yeah, dude, back at you. Mutual Adoration Society. Follow Chris on Twitter. You're always laying new stuff out there, stuff you see. You are relentless, and keep going because you're helping everybody. I sure appreciate it.
All right, Craig, we'll check back in soon, homie.
All right, all the best, my friend. Stay safe down there.
Adios.